I'm Nikita Burdick, and here's your market update for September 2022. First, I want to highlight what the market has been doing this week of the 19th of 2022, as it is very interesting. We saw that the UMBS, or mortgage-backed securities, was down substantially. At one point, as shown, it was 20 basis points, but overall the UMBS was going in a downtrend up until the Federal Reserve announcement on 9/21. One thing that I do as a mortgage lender is analyze the UMBS and Treasury charts to determine when to lock. I saved a client almost an entire basis point by doing this. Prior to the Federal Reserve meeting, the UMBS had actually broken through the Fibonacci floor. Next, on the UMBS chart, you can see that the last green candle on the chart has a long wick, which is called a bullish hammer. This typically signifies that we're nearing the end of the downtrend and soon there will be an uptrend. As such, I chose to wait until after the meeting to see what rates did before I locked any clients. Now let's fast forward to September 21st, 2022. The Federal Reserve raised the federal funds rate by 75 basis points, or 0.75%, bringing the target range to 3.75%. They are also focused on reducing their balance sheets. The Fed indicated that in the coming months, they are going to be looking for strong evidence that inflation is coming down, consistent with inflation returning to 2%. Ongoing increases will still be necessary, and the pace of which will depend on the oncoming data. Powell re-emphasizes his speech at the Jackson Hole meeting that at some point it will become appropriate to slow the pace of increases to the federal fund rate. The decision will continue to be made meeting by meeting. However, he did state that restoring price stability will likely require maintaining a restrictive policy, and that historical record cautions strongly against prematurely loosening their policy. As such, we can expect to see more hikes to the federal funds rate. As I predicted, after this meeting, rates went back down a little, and I was able to lock my clients at a rate that would have cost them an entire discount point more. This is the benefit of working with a lender that understands the market data and researches these type of things. That helps me transition to the next part of this market update video. I thought it would be a good idea to go through the different reports that released this month by also explaining these reports to you. You really need to understand why these reports are important to know why I'm going over them every single month. Okay. So first, and probably the most important reports for mortgage rates, are the inflation reports. Why is this? Well, as discussed in my videos, inflation is the arch enemy of bonds, and particularly the mortgage-backed securities and the 10-year Treasury bonds. They have significant impact on mortgage pricing. I will have a video posted on my YouTube regarding bonds and how they affect mortgage rates. Stay tuned. But simply put, inflation erodes bonds investors' powers from the fixed rate of return that they receive over time. As such, investors have to be compensated from this erosion effect by higher interest rates. There are two main inflation reports, the Consumer Price Index and the Personal Consumption Expenditure Index. They are each reported on a monthly basis and gives us data from the previous month. As you can see, inflation is calculated on a 12-month rolling basis and continues out each month. So if we are reporting in February, then we're using the numbers through January, and you add up through, you'll see year over year of 2%. So if we use this knowledge to plug in what people are expecting the inflation rate for, say, February will be, then we can predict what we expect the year over year to be before it reports. These expectations will sometimes cause the markets to react, and therefore rates react. Both reports have two components to them: the headline inflation, or in other words, the overall inflation, and then the core inflation, which strips out volatile food and energy prices. Fed likes to look at the core rate because they can influence the other factors with the federal monetary policy. However, they cannot influence food and energy prices. Okay, let's look at the CPI, or the Consumer Price Index. Essentially, this means prices on a fixed basket of goods and has significant weighting towards out-of-pocket medical expenses. This is the one that MBS Highway and someone like myself look at more closely, because measuring the cost to put a roof over your head and medical expenses is a big indicator as to the impact on the consumer. Let's take a look at what the September report had to offer. The Bureau of Labor Statistics, the BLS, released its August Consumer Price Index on September 13th, which showed prices rose 8.3% year over year and 0.1% over the prior month. The expectation was that the year over year would be 8.1%. Since it was higher than expected, people are now speculating that this increase in inflation has sealed the deal for that 75 basis point hike in September, which we saw. Okay, increases in shelter, food, and medical care were the largest increases. These increases were largely offset by the decrease in gas, yay. The stock market reacted very drastically to the CPI release. In fact, it fell nearly 1,300 basis points on Tuesday. Treasury yields actually rose a little, but overall the UMBS mortgage-backed securities was down. As you can see at 6:30 a.m. Pacific time, the UMBS was down 73 basis points. The 5% represents the coupon, which is the interest rate being paid by the investor. Here, the rates have moved 5% at a price of 99.67. The bond market is not reacting too bad. By watching the market a little this morning, they seem to be selling off a little bit and rates seem to be up a bit. This shows how much one report can cause effects on that market. The PCE, or the Personal Consumption Expenditure, measures prices on goods but allows for substitutions. PCE does not focus on housing or out-of-pocket medical expenses. Rather, it focuses on Medicare and Medicaid. As a result, some say that the PCE underestimates real-time inflation. However, it is the measure that the Federal Reserve favors, and specifically the core PCE, because it's most influenced by their monetary policies. Because the core PCE is stripping out certain aspects and allowing for substitutions, but it is the one that the Fed is looking at. The next PCE report does not come out till September 30th, and this video is being recorded on September 22nd. As such, there will be a separate video at some point going over the PCE report. The next reports that I tend to look at when creating my market updates are the employment reports. The two main employment reports are the ADP Employment Report and the Bls Job Reports. The ADP Employment Report comes from Moody's Analytic, and it tracks private employment in the US but does not include governmental jobs. It is based on anonymous and aggregated data derived from nearly 460,000 US companies and approximately 26 million private sector US workers. Really, this data is used as a nice preview to the Bls Jobs Reports white show. I typically focus on the Bls report. The Bureau of Labor Statistics, or the Bls Jobs Report, is a monthly report that typically comes out the first Friday of each month. It summarizes the total non-farm payroll employment in the United States by surveying businesses and households. These are the two surveys that are used, the Establishment Survey and the Household Survey. Okay, so the Establishment Survey outlines job creation and employees paid during the sample week, which encompasses the 12th of the month. It also tracks numbers of companies that birth or create and die or fail. The Household Survey is collected differently than other surveys. It is by phone calls, and it's approximately 60,000 households during the sample week. Since the US has on average 124 million households, that one call represents over 2,000 households. The next thing that is crucial to understanding when reading employment reports is the unemployment rate. There is more than one type of unemployment rate, but the one that is most used is the U3 unemployment rate, which measures the number of unemployed individuals who are actively seeking a job divided by the total labor force. The U.S. unemployment rate is another measure and is arguably a better measure because it also measures those who are working part-time but desire full-time employment, and it measures the amount of discouraged workers. Next, the Bls Job Reports also tracks the average hourly earnings and the average weekly earnings, which essentially tells us how much people are earning. Okay, so finally, before we get into the specifics of the most recent jobs report, I think it is important to identify a drawback to the Bls Jobs Report. The unemployment rate under both the U3 and the U6 are defined as those actively in the labor force. However, to be considered actively in the labor force, you have to be currently have a job or been looking within the last 4 weeks to the sample study. This could be individuals who are wanting to be part of the labor force and just have not been looking within the past 4 weeks, so it's not including those people. All right, so what do the Bls Jobs Reports show? On September 1st, 2022, the Bls Jobs Report was released. The initial jobless claims, which measures those applying for unemployment for the first time, decreased by 5,000, which is now at 232,000. The continuing claims, which measures those who have received unemployment before and continue to receive, increased 26,000 to 1.438 million, making it the highest level since April. All right, I know we've talked a lot about reports and markets and updates at this juncture of this video. However, it's important to understand all of the elements and what goes into my daily, weekly decisions on when to lock by determining and assessing the market is doing and what it might be doing. The next set of reports is a mixture of what I'm going to call other reports. The first other report that I want to go over is the mortgage applications by the Mortgage Banker Association, or the MBA. This report is released every week and typically on Wednesday. This report is great for mortgage industry because it gives us a close to real-time pulse of the mortgage market. Within the report, you can see overall applications, purchase applications, and refinance applications from the previous week. It also breaks down the average interest rates and where they're going. I also like to look at Mortgage Daily News for average interest rates. Okay, so for the week ending September 14, 2022, MBA showed that mortgage applications decreased 1.2% from the prior week. Refinance decreased 4%, and they're down 83% from last year. Next, we have the gross domestic product, or the GDP, which is reported quarterly. My last market update went over the Q2 GDP numbers, which that video can be found on my YouTube channel. However, GDP basically functions as a scorecard of the country's economic health and is a common recession indicator. If you remember from my last market update, I reported that Q2 GDP numbers represent a second consecutive negative GDP reading, which is typically indicative of a recession. However, it is the NBR that officially determines whether we're in a recession or not, and the NBR, or the National Bureau of Economic Research, has yet to publicly state that we are in a recession. In fact, the Federal Reserve continues to act in the mode of fighting inflation and price stability. Finally, the last thing I want to bring up that I closely watch are Treasury bond auctions. Why do I watch the 10-year Treasury bond auctions? Why would anyone? Well, I have a video on my YouTube channel that goes into detail the relationship of Treasury bonds and mortgage-backed securities, or the UMBS. However, as mentioned once in this video already, the Treasury bonds and the UMBS tend to move in a similar direction over time due to the similar duration and characteristic as a bond debt instrument. The most important thing to look at for a mortgage lender like myself is the demand level, which is measured by the bid to cover the ratio and the foreign participation. On September 12, 2022, the 10-year Treasury note auction occurred. Since the last auction, Treasury yields were 0.5%, and depending on what they did in September may continue to climb, causing rates to climb. However, we did not see much demand at this auction, and that likely had to do with the anticipation of the CPI release the very next day, which we have already covered in this video. So these are your reports and these are your market update for September. Thank you for watching, and please contact me if you have any more information.